Welcome to Forte's market commentary for the period concluding December 2011. In this commentary, I'm going to discuss the 6 months up to December, also the 12 months, but also focus on the impacts of FOFA and also the expectations for 2012 and beyond. The full market commentary is available on my website www.forteassetsolutions.com.au. It would be true to say that the last 6 months of 2011 was the most difficult trading period that I had seen in my 9 years of selling, advising and consulting financial planning, risk practices and also dealer groups. It was marked by continued negative sentiment that came with every press release and also the FOFA releases in the latter part of 2011. We normally trade on financial planning businesses somewhere between 3 to 3.5 times recurring revenue. But for the first time, we had a 6-month period where, concluding December 2011, the actual multiple average applied was 2.88. So the 2.88 times represented a 12% decline in multiples of being paid in the preceding 12-month period. For the average financial planning business, that meant a decline of $144,000 in value. What also happened through this period of time is that there was sustained negotiations. When you're receiving offers as low as 2.2, which I'd previously received for businesses that were in liquidation or receivership, we're finding that the average gestation period from bringing a business to market to actually selling was close to 9 months. This was not only because of negotiation, and many times it was on a different revenues being accorded different multiples, but it was also due to significantly more due diligence was being done, and the focus of the due diligence was actually on product segmentation. Additionally, it was also some of that time was in the finance. Banks are a lot more cautious about their lending criteria, but also what they've had is a bit of a bottleneck in their own back office because of the number of loans that are being required in financial planning businesses as we speak. And that's a real testimony for the trading period that we've been in. Whilst the market sentiment was largely negative through the latter half of 2011, it did recover in November of 2011 with the release of Tranche 2 and also in the belief or assumption that volume overrides would be protected in some shape or form. With that level of confidence, buyers returned to the marketplace and we saw the stabilization of prices reflected in the recurring revenue. It was in this period where we were seeing businesses, very good businesses with predominantly A and B clients that were struggling to come up to market averages of 3 times or greater. We saw that C and D client books around the size of 200,000 recurring revenue in extremely high demand. We had this dichotomy of where very good businesses, large businesses and profitable businesses were struggling to get to 2.8, 3 times. We had C and D clients, books that were actually getting 3 times and sometimes greater. Now the reason for that was the demand factor around small books. And why there is such demand is not only because of the institutional war that is on of those types of books that can be used for advisor attraction, but also it was that these books are very valuable so you can pick them up and put them into your existing infrastructure. And let's say 200,000 at 3 times, 600,000 purchase price, debt servicing of 60, free cash flow created of 140 with no infrastructure. There's no principal that goes with the business. It can immediately be brought over, dropped into the buyer's existing infrastructure, get full utilization of the team, and therefore there was that demand. It was small and it was easy to handle. The larger businesses, though, which has ongoing infrastructure with principal, retention and the like, and often with the leases continuing for a period of time, that's where the demand fell. And so we really did have this dichotomy of values. So FOFA has impacted demand, but it has not increased supply. The reason that people are selling at the moment is primarily due to financial stress, and the vast majority of my sellers are in their 40s. What we're seeing is the deferment of retirement. Retirees or potential retirees have seen the diminution of their superannuation, but they've also seen the decline of their business values, primarily through the recurring revenue. And so if they can, health permitting, they're deferring their sales. Now this may have a future impact if we've got a supply overhang that continues to build over the next few years. There is no mass exodus due to FOFA. There is a level of disillusionment with the industry, and I think that's primarily by advisors continually having to go back to their clients with bad news. But the reason for the sale is symptomatic of the economic environment that we find ourselves in, and not the legislative proposals that we currently are facing. My expectations for 2012 is that we will see the return of normal multiples, somewhere around about the 3 to 3.3 times. It's likely to be in a falling interest rate environment, and we're seeing better businesses. Over the last few years, every principal has had to have a look at their business model, have a look at their client engagement, have a look at their underlying FUM, and look at the risks associated with their business, and they have addressed it. So I believe the businesses that will be coming to market are probably some of the better businesses. There is a greater focus on profitability or EBIT. The vast majority of valuations are still done by recurring revenue. However, higher recurring revenue multiples are afforded to higher profitability businesses. There is potentially some risk in the C&D client book sales, and the risk for that is that within FOFA legislation, it is proposed that if a book is sold and the licensee changes, then that book will be subject to opt-in and will not be grandfathered. What this means for sellers is that they may be restricted to selling within their own dealer group. As soon as you restrict the demand, you're going to impact on the multiples. And so I think that we are likely to see an increase of the sale of C&D books as we run up to potentially July 1 of 2012 or beyond for that type of business. There is still a continued absence of organic growth, and in the absence of organic growth, inorganic strategies will be explored. So I believe that we will still see high demand, and that's been evidence of returning to the office in 2012 by the number of buyer inquiries that we've been receiving. I think that we will continue to live in challenging times, and with the economic environment, there will continue to be financial stress experienced by business principals. And so therefore I see a consistent supply coming to market. All in all, I believe that the last 6 months of 2011 was an apparition, and I believe that the markets will recover with growing confidence about what legislative environment we'll be acting in. Thank you very much.